Recent developments in the United States financial markets provide a clear illustration of the complex interplay between policy signaling and economic reaction. On Thursday, April 10, 2025, U.S. stock indices experienced a marked downturn, effectively erasing a significant portion of the substantial gains recorded just one day prior. The S&P 500 index fell by 3.5%, following a notable 9.5% surge on Wednesday, April 9. Similarly, the Dow Jones Industrial Average decreased by 1,014 points, representing a 2.5% drop, while the Nasdaq Composite saw a reduction of 4.3%. This sharp reversal occurred against the backdrop of ongoing trade tensions, particularly those involving the United States and China. Initial positive market response on Wednesday followed President Trump's announcement of a pause on many global tariffs. However, this sentiment shifted dramatically on Thursday. Persistent concerns regarding the specific, high tariffs applied to Chinese goods remained a focal point. The situation intensified following clarification from the White House regarding the precise tariff rate on Chinese imports, which confirmed a cumulative rate higher than previously indicated in public statements. This sequence underscores the market's acute sensitivity to the specifics and perceived trajectory of trade policy, especially within the context of the U.S.-China economic relationship. The initial surge observed on Wednesday, April 9, can be attributed directly to President Trump's announcement regarding a suspension of numerous tariffs globally. Market participants interpreted this move as a potential easing of broad trade-related economic pressures, prompting significant buying activity and driving indices sharply higher. However, this positive assessment proved short-lived, as underlying strategic trade issues remained unresolved, particularly concerning the bilateral relationship with China. Concerns persisted regarding the specific, elevated tariffs imposed on Chinese goods, reported to exceed 100%. The positive sentiment generated by a general tariff pause was insufficient to counter the negative implications of specific, high tariffs confirmed on a major trading partner like China. The rapid shift from euphoria back to apprehension underscores the market's focus on the tangible economic consequences stemming from the ongoing U.S.-China trade conflict. Analytical perspectives offered insight into the limited scope of the relief provided by the global tariff suspension. UBS strategist Banu Baja, for instance, noted that while the decision represented a shift, the economic damage inflicted by the preceding trade conflict was not entirely reversed by this action alone. The core of the administration's trade strategy appeared heavily weighted towards China, involving tariffs substantially higher than those applied elsewhere. This specific targeting created a contrasting dynamic, a general easing on one front, juxtaposed with continued significant pressure on a key economic relationship. Projections indicated that even a negotiated reduction in these China-specific tariffs, potentially to 50%, combined with residual tariffs on other nations, could still exert considerable drag on the U.S. economy. Specifically, such a scenario was calculated to potentially dampen anticipated growth in U.S. corporate profits, a fundamental driver of equity valuations. Therefore, the initial market optimism encountered the hard reality of sustained, targeted economic pressure via the China tariffs, which remained a central element of the administration's policy. The situation escalated significantly on Thursday, April 10, when official clarification regarding the exact tariff structure emerged from the White House. This communication specified that the effective rate applied to Chinese imports would stand at 145%. This figure represented an increase from the 125% rate mentioned by President Trump in a social media post the previous day, once all applicable pre-existing tariffs were factored into the calculation. The immediate market reaction to this news was pronounced. Losses across U.S. stock indices intensified following the clarification, indicating a direct causal link between the newly confirmed tariff level and investor sentiment. At its lowest point during Thursday's trading session, the S&P 500 index registered a decline exceeding 6% before partially recovering to close down 3.5% for the day. This amplification of the downturn demonstrates the market's extreme sensitivity not just to policy direction, but to the precise, verified details of implementation, especially when those details confirm a more economically restrictive environment than previously understood. The clarification effectively negated the residual positive effects of the prior day's announcement and reaffirmed the significant perceived economic threat posed by the targeted tariffs. Observing the rapid oscillation between significant gains and subsequent losses within a 24-hour period highlights the prevailing volatility in financial markets. This instability is not arbitrary. Rather, it closely mirrors the shifts in perception driven by trade policy announcements and subsequent clarifications. The dynamic demonstrates that underlying anxieties concerning the economic impact of the US-China trade war persist, even when temporary measures suggest a potential de-escalation. Such pronounced market swings underscore the significant economic uncertainty generated by the ongoing trade dispute. The high tariffs directed specifically at China and the lack of clear resolution create a challenging environment for corporate planning and investment decisions. Businesses face difficulties in forecasting costs and managing supply chains when confronted with potentially large and unpredictable tariff liabilities. Consequently, projections for corporate profitability, as highlighted by analysts, face downward pressure, influencing broader economic outlooks and investor confidence. The events of April 9th and 10th, 2025, reveal a financial market exceptionally reactive to the nuances of trade policy communication. Ambiguity, conflicting signals, or, as witnessed, clarifications confirming more stringent measures than initially perceived, can trigger substantial market adjustments. This sensitivity reflects a fragile landscape where geopolitical economic strategy directly dictates market behavior and stability. Ultimately, the sequence of events culminating on April 10, 2025, serves as a stark operational demonstration of how specific trade policy actions, particularly within the complex US-China dynamic, directly influence financial market stability. The brief interlude of positive sentiment following the general tariff pause was demonstrably insufficient to override the persistent, fundamental concerns tied to the high tariffs imposed on Chinese imports. Confirmation of the elevated 145% rate acted as a decisive catalyst, exposing the fragility of the preceding day's gains and reaffirming the market's deep-seated apprehension regarding the economic consequences of this targeted trade conflict. This episode clearly illustrates that market behavior remains acutely tethered to the tangible realities and communicated specifics of trade policy, with the unresolved tensions between Washington and Beijing continuing to cast a long shadow over economic certainty and investor confidence. Thanks so much for watching. If you enjoyed this analysis, and be sure to give it a thumbs up and hit that subscribe button for more geopolitical insights like this. I love hearing your thoughts, so drop a comment below and let's keep the conversation going. Share this video with anyone interested in deeper perspectives on current events. Until next time, stay informed and think critically. Thank you.